All right, welcome to the Talk Tickers briefing. KeyCorp just put out their Q4 numbers, and honestly, they look pretty good. But the stock took a bit of a nosedive right after. So what's going on here? Let's dig in and figure it out. So yeah, this is the big puzzle we're trying to solve today. You've got an earnings beat, you've got them raising guidance for the future. I mean, that's supposed to be a recipe for a pop in the stock price, right? But it went the other way. So there's obviously a disconnect here, and we're going to get to the bottom of it. Okay, so first things first, let's look at the headline numbers. And really, on the surface, this was a clear beat. And here you go. The proof is in the pudding. Adjusted earnings per share came in at 41 cents, 2 cents better than the street was expecting. And on revenue, they cleared $2 billion, also a nice beat. I mean, this is exactly what you want to see as an investor, a clean beat on both the top and bottom line. It shows they're firing on all cylinders. So you got to ask, where did this beat come from? Well, a huge driver was this number right here, a 15% pop in net interest income year over year. And, that's basically the bank's bread and butter, right? It's the money they make from the spread between what they charge for loans and what they pay out on deposits. And a jump of 15%, that's not just good, that's fantastic. And it gets even better when you look at their efficiency. Their net interest margin, or NIM, actually expanded by 7 basis points just from the last quarter. Now, a basis point is just a fancy way of saying 1/100%, but what this really tells you is that they're getting more profitable. They are literally squeezing more juice, more profit from every single asset on their books. That's a sign of really smart management. Okay, so numbers like that don't just happen by accident. This wasn't a fluke. There's a real story here about how they're optimizing the business and focusing on returns. And this is the phrase that management kept coming back to on the call. Balance sheet optimization plus lower deposit costs. What they're really saying is, hey, we're not just getting lucky with the economy. They're actively making moves under the hood to make the bank stronger and more profitable. So what does that actually look like? Well, here's the playbook. First, they're remixing the balance sheet. Think of it like a sports team trading players. They're letting go of lower profit consumer loans to make room for higher profit commercial loans. On top of that, their investment banking arm had a great quarter, bringing in some serious fee income. And they're being super disciplined about what they pay for deposits. The cherry on top? They bought back $200 million of their own stock, putting cash directly back into shareholders' pockets. This is a multi-pronged, very intentional strategy. All right, so that was Q4, but what about the future? Well, management laid out their plan for 2026, and it's all about something called the leverage play. And trust me, this is the kind of stuff that gets Wall Street really paying attention. Here it is in a nutshell. They're projecting that revenues are going to grow by 7%. But, and this is the important part, they're planning to keep expense growth to just 3.5%. So revenue is growing at literally double the speed of costs. That gap, that's where the magic happens. It's called positive operating leverage. And this is really the holy grail for a lot of businesses. When your revenue grows faster than your costs, your profit margins just keep getting wider and wider. For every new dollar you bring in, more and more of it drops straight to the bottom line as pure profit. It's the sign of a super efficient, scalable company, and it's exactly what investors love to see. Okay, so this brings us right back to where we started. We've got a great quarter, we've got a great outlook, so why on earth did the stock fall? Well, this is where we have to decode what the market was thinking. It really was a tale of two competing stories. So on one hand, you have the bull case, which we've just been talking about, right? Strong earnings beat, expanding margins, a great plan for the future, and big buybacks. That's all fantastic. But there were these other things weighing on investors' minds. For starters, there's still some noise from an activist investor, which always creates a bit of uncertainty. Then there's the big question. Can this great interest rate environment last? And maybe the biggest factor of all, look at that run-up. The stock was up 28% in just 3 months. So expectations were through the roof, and a lot of people just saw this as a perfect time to lock in some profits. It was kind of a sell the news event. So, with all that on the table, what's our take? Where does this stock go from here? This is what we call the next call, where we lay out our own thesis on KeyCorp. And our call is this. We're rating the stock outperform. We think that initial dip was actually an overreaction. We believe the market is getting too hung up on the short-term noise and is really underappreciating just how powerful this strategic shift is for the long run. Our whole case really comes down to 3 main pillars. First, we believe they can actually deliver on that growth plan. That positive operating leverage story, we think it's real and it's powerful. Second, this focus on capital returns, especially the buybacks, isn't going away. It provides a nice, steady return for shareholders. And third, we think their profit margins are more durable than people think. The work they're doing on the balance sheet should help protect them, even if interest rates get a little weird. So, let's put some numbers to it. For next quarter, we're actually calling for another small beat, around 42 cents per share. We think the positive trend for the stock will continue over the next 12 months. And that brings us to our price target. We see a path for KeyCorp to get to $25 a share.
So to wrap it all up, the big takeaway is this. Has the KeyCorp story really changed? We think the answer is yes. It feels like they're shifting from being just a traditional bank that's all about growth for growth's sake and transforming into a much more disciplined, shareholder-focused capital return machine. And that's a very different story. And just a reminder, this is our analysis. It is not financial advice.